One of the challenges with creating forecasts and budgets is that often one adjustment will impact many other accounts. For example, if you plan to increase sales, that's also going to impact your cost of sales. And then if we consider the balance sheet, it'll likely increase your accounts receivable, decrease your inventory, and also have an impact on accounts payable. So there's many impacts of just one adjustment. And you can obviously go and create separate adjustments for each of these aspects. But what you ideally want is to be able to do scenario analysis or to be able to quickly update the forecast or budget when your client decides that the percentage increase in sales is no longer feasible. And to do that, we need to link all of these adjustments. And that's what we're going to show you in this video. How can you create an adjustment to sales? And if you go and change that adjustment in future, how can you make sure that it automatically updates whatever we've done to cost of sales, accounts receivable, and the other relevant accounts? Okay, so we're going to just look at a simple example whereby we increase our sales. So I'm going to go and increase my sales with just a normal quick adjustment. I'm going to go sales, add quick adjustment. I'm going to get it to start in November, continue till the end of the forecast. And I'm going to ask it to increase each period on the prior value by an amount of 10%. I'm then going to click save. And now I can see that my sales have been updated and they're updating each month. Okay, so I've increased my sales, but now I know that an increase in my sales is also going to impact other aspects of my financial statements. And we can currently see that it's impacting my cash and cash equivalents because remember, Syft assumes that the other side of every adjustment is cash and cash equivalents. But in this case, we know it's not. We know that these are going to actually be credit sales. So we want it to impact our accounts receivable. So how do we get Syft to do that in a way that links these transactions? Well, we're going to create an advanced adjustment. So we could either click here or we could go into accounts receivable and add an advanced adjustment. We then are going to give a detailed description of this. So we're going to say increase in sales part 2 so that it's easy to see all of the adjustments that link to this one factor, which is an increase in sales. We're going to select our start date and our end date, which I'm just going to make the end of my forecast, but you'd obviously have to select whatever is relevant for your forecast or budget. We're going to make it recurring because the sales had a recurring increase, but this would obviously match whatever increase you had in the sales. And then we're going to choose that it happens every month. We're then going to select a formula because we need to create this formula to build out this connection between sales and accounts receivable. Okay, so what we're telling Syft is how should Syft calculate the accounts receivable for the current period? And if we think about it, the current period's accounts receivable will be equal to whatever the previous period's accounts receivable was, plus the movement in sales. So we're going to just create that formula. So we're going to go balance sheet, accounts receivable prior. So we're going to prior accounts receivable, and then we're going to add, and we're going to open brackets, we're going to add the movement in our sales. So the movement in our sales would be sales for the current period less sales for the prior period. And then we can close brackets. And now we have what our current accounts receivable should be, which is our prior plus our movement in sales. I want to add one more level of complexity, which might apply to some of your entities, and that's if you have VAT or GST. Remember, if you have VAT or GST, your accounts receivable is not only going to increase by the amount of the sale, but it might also increase by how much VAT or GST the client will need to pay you. So I'm then going to go and multiply this by 1.2 or whatever the VAT or GST percentage is. So if my VAT or GST percentage was 15, I would times this by 1.15. Okay, so now we've built out a formula that links the balance of our accounts receivable to the increase in our sales, and we've even considered VAT or GST. I'm then going to click save, and now we'll see that my accounts receivable has updated and it's increasing in line with my sales. Now, if I go back to my profit and loss and I were to change the increase in my sales, that would automatically change the increase in my accounts receivable. Okay, so that's a great start, but we know that there's a lot of other things that would be impacted by this increase in sales. And one of those is cost of sales. So when your sales increase, you likely have more cost of sales. And so we're going to link our cost of sales to our sales. So to do that, we're going to go and make an advanced adjustment. We're going to say sales increase part 3. We're going to select for the entire forecast period again, make sure it's every month. And again, we're going to select the formula. And now we're going to say, well, what should our cost of sales be? And our cost of sales should be our sales times whatever our gross profit percentage is. So that will obviously differ depending on your entity and what you are forecasting or budgeting for your gross profit percentage to be. But in my case, we're just going to say the gross profit percentage is 60%. So I'm going to go my sales. So whatever my sales are for the month, the current sales. So whatever my sales is, times by 0.6 will give me my cost of sales. Please use decimals and not percentages. We're then going to click save. And now we'll see that our cost of sales is always 60% of our sales. And again, if we were to change something in our sales, it'll automatically update our cost of sales. Okay, great. So we know that our sales, accounts receivable, and our cost of sales are updated, but there are more factors that are impacted. When your cost of sales increases, that means your inventory decreases, right? So we're going to go and consider the impact of the sale of cost of sales on our inventory. So we're going to go to the balance sheet. I'm going to go to inventory. We're going to again add an advanced adjustment. We're going to say sales increase part 4, I think it is. Select the period. So this part's pretty repetitive. Make it every month. And again, we select a formula. Okay, so now we're telling Syft what should our inventory be? Well, our inventory will be whatever inventory we had last period less what we sold. And what we sold would be our cost of sales. So I'm going to go inventory. So it would be current assets, inventory prior, so prior inventory, less cost of sales. Perfect. So that's the formula that's going to cover how much inventory I've sold. I'm going to click save. Okay, now you'll see that our inventory has decreased quite dramatically. And that's because if we think about it, in the first month, if we just toggle this off, we only had 4,000 worth of inventory. But how much did we actually sell in the first month? Well, we sold 11,000 worth of sales, which was 6,600 worth of inventory. So it makes sense that our inventory is negative 2,600. So it's definitely working. But we haven't considered the fact that in order for this business to continue operating, they actually also need to go and purchase inventory. So let's go and update this formula to also account for the fact that we plan on purchasing inventory. So we're then going to go and change it. So prior inventory plus whatever we buy less whatever we sell. So let's go and add that in. Okay, so it's prior inventory plus whatever we buy less whatever we sell. But now what would we buy? Well, this will depend on your company's policy. But I'd like to suggest that you should at least replace whatever you've sold. And if you're planning for your sales to be increasing each month, then you probably need to increase the amount that you buy and purchase more than what you sold. So for this example, we're just going to go and purchase last period's cost of sales. So we're going to go prior cost of sales, and then we're going to multiply it by 1.11. So remember, we are hoping for a 10% increase in sale each period. So we're going to try just offset that to make sure we never run out of stock. So now we've updated this inventory formula to say current inventory should be last period's inventory plus whatever inventory we buy minus whatever inventory we sell. Now, obviously, this formula would probably differ depending on your inventory plan, and it might not be quite as simple as this, but for a forecast or budget, it's probably not going to be 100% exact. And this should just be a good general guide for all entities, and you can go and tailor this to whatever your entity needs. We then can click save. And now you'll see that we aren't going into an inventory shortage anytime soon, and that overall we actually have an increasing inventory balance. And that's because, remember, we're buying more than our sales are increasing. So perhaps we need to go and tailor that a little bit, maybe increase by 10.5% instead of 11%. Okay, so that's how we could then go and link our inventory. Okay, so the last aspect of the sale that we haven't yet included is accounts payable. So when we purchase more inventory, we then need to go and pay for this. Now, Syft has again automatically gone and put that contra in cash and cash equivalents. And so if you plan on purchasing your inventory on cash, then you don't need to do another adjustment. But if you plan on purchasing it on credit, as many businesses do, then we need to consider this last step. So to do that, we're going to go and click on accounts payable, and then we're going to add an advanced adjustment. We're then going to go sales, increase, adjustment, part 6. We're going to select the time period. in much the same way that we did previously. It will be recurring every month, and I'm going to select a formula. So now we need to tell Syft how much it should calculate this accounts payable to be. And we want to link accounts payable to the increase in inventory, because remember, we're trying to link this whole transaction. Sales is linked to cost of sales and accounts receivable. Cost of sale links to inventory, and accounts payable is going to increase by how much inventory we purchase. So if you think of a T account, basically inventory increases by accounts payable and decreases by cost of sales. So we're going to recalculate that accounts payable. So to do that, we're going to go and say, well, how much inventory do we have at the end of the period? So we're going to go other current assets, inventory, and save. We're going to add to that the cost of sales, because that's how much inventory we've sold during the period. And together, that should theoretically give us the opening balance of inventory. But if it doesn't, we're then going to go and minus the closing balance of inventory. And so in effect, this is going to give us the increase in accounts payable. We're then going to click save, and we'll see now that Syft has gone and adjusted our accounts payable for these values. Okay, so now we've linked all parts of this transaction, and we can test this by going and seeing what happens if we go and adjust the amount of sales. So if we go here and we say, instead of sales increasing by 10%, we can increase it by 5. But before we do that, let's just check what the values are. So currently our sales is 11,000 and then 12,100. Our cost of sales goes from 66 to 7,260. And our balance sheet, we have accounts receivable of 10,200, which increases to 11,520. Inventory is from 4,060 to 4,126. And accounts payable 6,660 to 7,326. So just keep those in mind. And now we're going to go back to our profit and loss. We're going to go and adjust our sales by 5% and click save. And now we'll see that our sales have changed. It's now 10,500 and 11,025. Our cost of sales is also updated in line with that. If we go look at our accounts receivable, that's also now changed along with our inventory. And then our accounts payable has also changed going forward. So this is a way we can link all the transactions, so we can go and consider what happens if our sales increased or if our cost of sales changed. We could, in the same breath, go and change our gross profit percentage. So if we considered what would happen if we had a different gross profit percentage, that would then go and automatically impact how much inventory we've purchased. And in the same breath, it would change our accounts payable. The only other aspect we would then need to go consider is the repayment of this accounts receivable and accounts payable. And if your payment term is 30 days, then you can go and include a formula to pay the previous month. But if you have a longer repayment term, then you'll have to go and make more manual adjustments.